But this is more about like how do you structure the investment side of things. So there's a couple ways. One, real estate lab. All right, guys, what's up? Chapter 8. We're going to be going over all things financial related, structuring deals, different types of structures, syndications, in depth on syndications in this chapter. We're going to go through all that. We've talked about, LLC hierarchy and setting up those types of things in order to buy a deal. But this is more about like how do you structure the investment side of things. So there's a couple ways. One, the most simple form is you can buy a deal on your own. You go out, put a property under contract. You have enough money to close it and capitalize it. You get a bank to put up 80%. You put up 20 plus renovation costs, and you fund the deal yourself. Maybe you 1031 into it. That's another way to buy on your own. That's the first way. Second way is a joint venture. Joint ventures are great for, I would say, 1 to 6, maybe 1 to 6 people. You start to get over 6 people and it gets a little bit more complicated. But I would say the easiest way this is for a small group of people. It's simple. You're just going to need an operating agreement for the property to show who is all involved. Joint ventures, normally most people that are on the operating agreement and that are investing, you are some form of a decision maker, maybe not entirely, but you don't have a lot of limited partners, right? Because as you add more limited partners, passive investors, you're getting yourself into more of a syndication, which is what I'll talk about next. But a joint venture is fairly easy to set up. It should be pretty quick. Like I said, it's just an LLC setup and then an operating agreement dictating who's in charge, how much ownership is being divvied up, payouts, distributions, tax loss allocations, and ownership percentages. And so joint ventures, it's all negotiable, right? Let's say I'm going and buying $1 million deal to keep numbers simple, and we need $300,000 to buy it. Well, I could go and find 2 people to put up $150K. I put up $0, and we go a third on the ownership, straight up third. Like I said, sky's the limit. You can organize it however you want. You could have 5 people put in 100,000, and you put in 100. 4 people put in 100,000. You put in 100, right? So you're each putting in 20% of the capital, but maybe you carve out an extra 10%, and you split the remaining 70 between those other 4 investors, right? And so they're each gonna get, I don't know, what is that, like 18% or something like that. So you can carve it up however you want. I've done JVs before where I had 5 investors put up on this one deal like $650,000, and we went 50-50. So that $650, they bought 50% of it, pro rata between them, depending on how much capital they brought, and then I got the other 50% for putting the deal together. It was just a really good, screaming good deal, and they all got amazing returns on their money, just with that 50%. So, like I said, sky's the limit. You can organize a JV however you want. It's for a small group of people. It's easy. It's quick. It's simple. You don't need any reporting. Just go ahead and set up that operating agreement. Have your attorney set up that operating agreement. Next form, you want to go and raise millions of dollars, and you don't have just 1 or 2 people that can put up $2 or $3 million, right? In which case you would just joint venture it. But you want to go raise money from a group of people, pool capital together. This is called a syndication. There's different types of syndications. I'll get into that in some of the next videos. However, syndication, simply put, is a way to pool limited partner investor capital together to go and buy a larger property where you otherwise would not be able to do it because you don't have all the necessary capital yourself. And so we're organizing these as syndication. It's very common to call them syndications. But it's a capital raise. You're putting together almost like a fund for buying a property or buying multiple properties, and we're going to put it out there and syndicate it and bring in multiple investors, normally 5 to 10 on the lower end, up to I have some deals where we have 45 investors. Like I said, I'll get into the intricacies of syndication a little bit more in the next couple of videos, but that is generally what has to be done. In order to syndicate, you need a SEC attorney, a real estate attorney who can put together not only an operating agreement, but a private placement memorandum. PPM is what allows us to syndicate a property. The SEC, as we know, likes to dip their hands into everything that has to do with securities, and they deem syndications close enough to selling securities that there are some regulations around it, and so they have a little bit control over the matter. They're saying if you're going to go out to investors and raise money where they are completely passive, they don't have a say, no decision making, we want you to follow these certain rules. And so in a syndication, there's rules on who you can raise money from. There's rules on how many people you can raise money from on a deal. There's rules on the relationships you need to have with these people, their accreditation status, are they accredited investors or not? There's a lot of rules, and I'm going to pull up in another video. I'm going to pull up the current rules and go over each of those with you guys, so you guys get the current rules as of mid-2022. They're always changing. But syndication is a little bit more extensive. It can cost anywhere from $5,000 to $15,000 to get these documents set up. So it's a little bit more costly. It takes a little bit more time, but it is what allows us to go and raise capital from a bunch of people and buy larger deals where otherwise we wouldn't have been able to. And so I've syndicated probably to date 10 or 12 deals, and then the rest I've done joint ventures or I've bought on my own. And so I've done a good mix of all of these. My personal favorite is the joint venture because you can get really creative with the structure. You don't have to go with something that's very typical. You can put no money down if you want to, or you can put as much money down if you want as you have if you want to. Same with syndication, but joint venture is easy. No PPM needed. You don't need to file a Form D with the SEC. I mean, it's a very easy way to structure deals, especially smaller ones, right? If you're the under $2 million range, you get maybe 5 to 6 people together to put the money up, and you just keep it simple with a joint venture. So that's my personal preference, but as we get into bigger deals, as have done larger deals, those have all been on a syndication basis, which has just made it easier to go raise capital from a lot of people and pull together $3 to $5 million, for example. So, and then the final way after syndication is a fund, and a fund is even further into the realm of complication. A lot more decisions have to be made on the setup side. Last fund I set up cost, I think, $25,000 to set up in legal costs. And there's a lot more that goes into it, a lot more planning. When you're setting up a fund, you're not just buying one property. It might be, in our case, a blind fund where people are investing, and then we're going out and buying properties after the fact. And so, there's a lot more that goes into buying a fund. Similar thing, there's certain regulations around it, just like a syndication, who you can raise money from, how many people, etc. But there's a lot more that goes into planning when it comes to a fund in order to market it, to come up with a business plan. How are we going to operate this thing? How are we going to exit this thing? And who the partners are and all that. So I've done a fund as well. So I've done a couple or at least one of each of these methods. But those are the 4 main methods for structuring the funding and capitalization of a deal. And in the next couple videos, like I said, we're going to go more in depth into each of these syndications, and I'm going to get into some numbers with you guys. I'm going to pull up the spreadsheets. I'm going to show you guys, hey, this is how it looks on a joint venture basis. Here are some returns at the deal level versus investor level returns, and we're going to get into all that kind of stuff. So check you out on the next one.